We'll explore 4 key investing rules from John Bogle. If you're unfamiliar with John Bogle, he founded Vanguard Group, the world's biggest mutual fund. As a result of founding Vanguard, he became extremely influential in the investing community, largely because of making index fund investing easily accessible for the average individual. Regarding his portfolio, Bogle stuck to 60% in a U.S. stock index fund and 40% in a U.S. bond index fund. However, later in his life, he became more conservative and shifted to a 50-50 mix instead. A key takeaway from Bogle's investing strategy is to invest mostly in index funds. According to a large-scale study by Morningstar, in the 10 years leading to 2014, passively managed funds outperformed actively managed funds by a little over 1%. The study looked at 562 actively managed funds in the U.S., which averaged 8.05% compared to 25 passively managed funds, which made 9.27% on average over the same period. The first key point in Bogle's investing strategy is to not rebalance. Many investment advisors provide rebalancing as part of their service. However, Bogle says if you want to do it, once a year is probably enough. A major reason for this is that you will have additional trading costs that will likely have more taxable gains. The next point is that Bogle does not invest directly overseas. He keeps his portfolio all in the U.S. markets because he feels U.S. companies offer greater security and consistency with returns compared to stocks from other nations. Most large U.S. companies make more than half their revenue from outside the U.S., so buying U.S. funds gives significant exposure to international markets. Many disagree with Bogle's view, including Tim McCarthy, who is the former president of Charles Schwab. He says, no matter how great a country is, putting zero outside your own country is the wrong answer on both a risk and return basis. He believes having a minority portion in international stocks will help decrease your risk and increase returns over the decades. The third key point is to simplify your portfolio choices. A key way in which Bogle diversifies is by simply buying bonds. It doesn't need to be more complicated than that. However, if you're fine with experiencing large drawdowns, you can consider not diversifying and simply owning stocks to maximize returns. Most investors would struggle to hold a 100% stock portfolio during a market crash. Therefore, it's worth considering other asset classes which can help reduce portfolio volatility. Assets such as REITs, international stocks, and international bonds can help reduce risk and sometimes increase overall returns over the long term. With regards to bonds, you should generally try to own bond funds rather than individual bonds, as it helps manage interest rate risk by having funds with both short and intermediate durations. Simplicity also helps investors track and understand. A simple plan that uses low-fee investments, which you should know you can stick to over the long term, is vital for Bogle. A simple stock market index fund and one bond index fund are enough to get effective diversification from the market. The major benefits of a simple portfolio include lower costs and taxes, easier rebalancing, easier tax preparation, less time analyzing the markets, less time tracking the portfolio and record keeping. The next point to remember is to try and minimize costs by looking for a low expense ratio. To help illustrate how significant a difference lower costs can make, take a look at this diagram. The diagram shows how you can save hundreds of thousands just by saving 1% per year in expenses over the long term. Additionally, we want to try and reduce taxes by using tax-advantaged accounts such as 401k or IRA, especially for funds which are more actively managed. If you're using a taxable account, it's also worth looking into tax loss harvesting to help turn market downturns into immediate tax savings. To help summarize, here are the key points we've been through. Be careful rebalancing. Invest overseas with caution. Simplify portfolio choices. Don't underestimate the long-term savings from minimizing costs and taxes. The great benefit of following John Bogle's advice comes from simplicity and ease to set it up. It may seem overly simple. However, it has been proven to beat most actively managed mutual funds over the long term. If you liked watching this, please check out this video about John Bogle here. Please consider subscribing and click that like button because it helps. Cheers.